Welcome to ECNTRADE daily video. Before we begin, it should be noted that any advice is of a general nature only and that your personal circumstances have not been taken into consideration. Hello everyone, my name is Rob Clayton and thank you for joining me. Well, after an explosive week of volatility, the Australian dollar managed to crush the 60-day moving average. And from that, still needs a little bit further to support this call, as the MACD is a little bit towards the lackluster. As you can see, when we look at the MACD line and also the MACD, we can ascertain that the bullishness comes from when we see not only the histogram, but the line breaking through the midway point, which hasn't actually happened. So therefore, Friday's gains are seen as possible as short-term and not indicative of a long-lasting optimism to the bullish call of 70 cents, as I recently stated last week. Therefore, it could be viewed as a bear market rally. However, much evidence is needed to support the bullish call to 70 cents. Looking at the support level now at the moment, we can see that the pullback can easily look towards that 60-day moving average, which is somewhere around 67 figure 15. A close under 67 cents would reinstate the downside and look towards as initial targets of 66.60 and 66 cents and reassess from there. Moving on to the euro, well, the market was very whipsawed as the dollar index, which measures the greenback strength against a basket of 6 major currencies, was relatively flat, even though we did get quite a blockbuster week. Job creation in the US remained robust last month, according to the US Labor Department, despite turmoil in the banking sector. After the data revealed the US economy added 253,000 jobs in April, coming in much higher than the anticipated market forecast of 180,000, while the unemployment rate fell to 3.4 from 3.5. Earlier last week, as widely expected, the US central bank raised its benchmark lending rate to its highest level in 16 years as it battles to try and stabilize inflation. Now, from the unemployment number, there is much talk that we could actually see another hike in June and therefore could see the rate up around about 5.5% in the US. I feel that the actual outlook for euro is still remaining somewhat negative after printing another topside challenge around that 110.60.75 was rejected. And as you can see, we're getting negative signals coming through. We've got an engulfing candle posted back in April and another engulfing candle posted just a couple of days ago. And therefore could see a return, which I feel is on the cards, to 109.70 and down towards that key level of 109 figure 25 and reassess from there. As a break beneath there would give further scope down towards 107. Until we see a clearance of that 110.60.75 top, then I feel the measured move from the break of the downside of 109, as I mentioned, at 107. Looking at the current price action for dollar yen, the market is pretty much showing a bullish response as we get closer towards that 132 area, or more to be exact, 132.60.80, and therefore could see a further rise into this week if the dollar does recover. However, all eyes will be on the inflation data in the US this week, and from there we see any upticks that would indicate that or strengthen the view that the June hike of a potential 25 base points could be locked in. But we do need to see a little bit more data, as Jerome Powell did say in his statement and also in his press conference, that it does rely now on data. And let's see if we can find the initial bullish response, or see if it does emerge, that is, and therefore see a rally back towards the top side, with the resistance seen for dollar yen coming in around 134.45 and maybe on towards 136.20.30. I still feel any downward tests should fail. Sterling still putting in a relatively strong performance, and no doubt we will see this due to the fact that the inflationary numbers are still around 10%, and therefore has put speculation this week on terms of seeing the Bank of England rate decision, which could see a 25 base point rate hike. Looking to the technicals, let's see if the market can or at least take the challenge towards that 126.55 to 127 area and any pullbacks likely to be shallow due to the ADX supporting the bullish case. Well, after posting a somewhat long-legged or doji, the market has responded quite negatively as it got close to that key level. And I did point out on Friday, it was a point around 2068 to 76. Now, from this topside rejection, it's clearly seen back in May 20 or around that region, and also back in the resistance of challenging 2068, which we can see here was back in March 2022, that the rejection has put a somewhat turn, as I would call it, in the actual bullish case. And therefore, these strong gains that we saw recently from 1,980 could be returned. And if so, then I'm looking for a down challenge that is viewed towards 2009 to about 1,994.96 and reassess from there. Lifting this up a little bit, we can see now there is a base coming in somewhere around 78 to 84 in the short term. Technicals are heavy, so I do feel the bears are coming for spot gold. And looking back on the oil's last couple of days of bullishness, we can see that the response from that key level that was seen earlier from a rejection in March this year, that the bulls are still gaining and looking like they can continue. With the upside call seen, first of all, was at 71.40.60, now reached, then I've extended it now to 72.70 area, or maybe even 74 cents, and reassess from there. Well, that's a wrap for the morning. Thank you very much for joining me, and as always, look out for the intro report. I hope you enjoy the great start to the new week.